right, I'm going to go ahead and get going. I've got just a little bit after the hour, so we want to be aware of everyone's time. But thank you so much, everyone, for coming to this week's AI and Society Colloquium. We are a group that, if you're not already familiar with us, we look at all aspects of AI as relates to issues of ethics, of policy, of human implications of artificial intelligence, and so on and so on. And we are always very welcoming of folks who would like to collaborate with us, folks who would like to be involved. I'm dropping into the chat a link for some information on connecting with the AI and Society group at NC State. And we welcome your involvement with us, whether it's coming to a talk or whether it's collaborating on research or whatever. We have our next, let me just say, our next talk will be 2 weeks from today. We will have a guest from the University of Pretoria, Dr. Emma Rutkamp-Bloem. And so look for information about that. But today, we have a wonderful guest from close to home, right here. We have our NC State colleague, Dr. Sean Mancat. Sean is an assistant professor of analytics at the Poole College of Management. His research focuses on developing and applying statistical methods for addressing business, economic, and policy issues. His specialty is in using text documents to explain and predict economic variables, and in modeling and characterizing network structure evolution over time. And today he's going to be sharing with us a novel machine learning methodology for the assessment of bank health, interconnectedness, and systemic risk. So I'm going to go ahead and turn it over to Dr. Mancat. Thank you so much.
All right. Thanks so much for that introduction, Darby, and really for the original invitation to come and speak to the group and get connected with everyone here. This is only my second year here at NCSU. I spent previous 7 years at Cornell, and before that, University of Maryland. So I like to joke that I'm the most seasoned, to put it nicely, assistant professor you've met. It's been a long time since I've graduated. But in any case, since I'm new on campus, I'm still looking to meet like-minded folks, have good discussions, potentially collaborate, and so on. So I'm really thankful to be here. Jumping right into the presentation, let me mention that this is joint work with Celso Brunetti, who's an economist at the Fed, and Jeff Harris, who's a finance professor at American University. And though Darby did give a good bird's eye, 2-sentence description of my research agenda, I thought I might, since I am meeting everyone for the first time, spend a little bit of time just talking about the kinds of work that I do, and then we'll get to the actual paper. So the first thing I guess I'll note is that my formal training, though I'm sitting in a business school, my formal training and PhD is in statistics. And so kind of all the papers I write tend to have a strong methodological component to them. And I still do occasionally write papers that are just purely, here's a new technique for measuring X, Y, or Z, or estimating whatever. But having sat in a business school now for almost 10 years, I also end up writing a lot more applied papers where the empirical analysis and the policy implications are really the focus. And the types of data I work with tends to be either network data or text documents. On the network side, I won't say too much because I think the paper I'm presenting today is an example of that kind of work. But here you might observe an actual network. It could be a social network, a banking network, retailer network. It could be supply chain. You may not observe the full network, but only see certain edges, and so on and so forth. There's a whole gradient of the type of data that you might have access to. And if it involves spillovers and finding topology and that kind of thing on the network, I'm always interested in those problems. On the text mining side, you can see in terms of applications, I'd say it's mostly through collaborators that I've been exposed to things like privacy online. So I do have a paper or two that looks at kind of the use of stylometry, which is just like basically trying to fingerprint someone's writing online so that you can associate their identity with the way that they write. And we kind of look at the use of machine learning and AI for that. And I think that has very strong system design and societal implications. So I think that kind of matches the group's focus well. And other works as well. In terms of methods, I tend to work in topic modeling, sentiment analysis, and trying to bring in econometric techniques so that you can additionally do causal inference. So at a high level, that's the kind of stuff I work in. I'll just, indulge me for just a few more minutes. I'll describe one other paper on the text mining side before we get to the finance one that I'm presenting today. So I think this will give you a really good sense of the kinds of stuff I work in, and also what I'm hoping, in further collaborations to do here with someone maybe in the audience. So this paper was recently published in Information Systems Research, which is like one of the IT journals, I guess, for the business school world here. And that paper is strongly motivated by this incident with Dominique and Cell's bakery. Did anyone eat a cronut in the morning? Are you eating a cronut now for breakfast? They're very delicious. It's a croissant donut, if you don't know what it is. I personally don't eat them. It's too unhealthy for me, but they do taste good. And the so-called father of the cronut was this guy named Dominique Edsel. He's a French pastry chef. And he had this bakery in Manhattan that was incredibly popular. Like Jerry Seinfeld filmed an episode of comedians in cars getting coffee there. There's lines out of the door every day to get pastries and coffees and all this stuff. But interesting thing happened. One day, someone uploaded a YouTube video of, you can see the screenshots of that video, some mice or vermin running around on the kitchen floor. And not only did they post it to YouTube, there was a couple posts in like the local blogosphere in the food, local food industry, if you will, social media industry of New York City. And it got picked up in things like the Daily Mail and other, outlets. I think more importantly, it got picked up by the local government, like the food inspectors, the hygiene inspectors of restaurants, saw the video, saw the posts, went to the restaurant the very next day and actually closed the bakery down, like it no longer exists, due to severe, quote unquote, severe mouse infestation. So at a high level, this episode kind of demonstrates the utility of crowdsourcing, of social media, of having people post online reviews and taking pictures of their food and putting it on Twitter or Instagram or something, because occasionally there's actually useful information there, in this case about something like restaurant hygiene. If you actually look more closely into this, it actually gets more interesting because the Dominique and Cell Bakery was having a spotless, like the best possible record when it comes to their official hygiene quality. Like restaurants are inspected every year. And then in New York City, as they are in most cities nowadays, you get an A grade, a B grade, or a C grade, and you like post that on the storefront window. So this bakery received an A grade every time it was inspected since 2011. And so on the one hand, if you just go by those official numbers or the official statistics, this is a great place to eat. It's clean, it's hygienic, and so on. On the other hand, they were closed down for a severe mouse infestation. So what's going on here? Well, it turns out New York City has an open data initiative. where you can basically get the detailed data for any restaurant, and at any time they're inspected over several years. And so here's the last inspection before they were shut down. It happened a while ago. You can see the record is from February 2016. But they received an A grade. And interestingly, the inspector did say, I kind of highlighted it in blue here at the bottom, the facility is not vermin proof. There are conditions that might be attractive to mice and rats and that kind of thing. And so they should watch out for that, right? But there was no actual problem at the time. And obviously it turned into an issue. So if you're trying to understand, okay, they got an A grade, what happened? They were this great spotless restaurant. This gets a little bit into the nuances of how these inspections are done in New York City. But due to the local politics, when they created this hygiene inspection program, it turns out there are, due to lobbying of the restaurant industry, I believe, two ways that you can get an A grade in the storefront window. The first one is that, hey, the restaurant inspector comes to your establishment, does the inspection, you get whatever score. And if it's an A grade, meaning that you didn't get that many penalties, you just get an A grade, it goes in your storefront window, and they'll come back approximately a year later. If you get anything below an A grade, okay, so you're a B or a C, or maybe even worse than that, I guess, you actually don't put that grade on your storefront window. They put a grade pending sticker, and you can kind of see that here on your window. And the New York City inspector will come back within, I think it's like within 45 days at a random time, and they'll re-inspect you. And upon that re-inspection, whatever grade you get is what actually goes in your storefront window. So from a kind of economic point of view or a societal point of view, it turns out in the data, if you look across all restaurants, there are kind of two groups of restaurants that consistently get A grades. The first one are restaurants that just upon their initial inspection, they always get an A grade. So they're just spotless all the time. And that's like the ideal case, right? The other group is what you can see like on this graph is labeled as PAPA, meaning they get a really bad score on their initial inspection. That's like B or C quality. So that's not a place you want to eat. Especially if you're a germaphobe or something, you really don't want to go there. But they don't get that grade. They just get a grade pending. They know they're going to get re-inspected, so they clean up. Now it goes back to an A. The next year comes around, it's again P for pending, back to an A, and they literally bounce back and forth. And in economics, this is what's called moral hazard. And it's literally the area kind of under the curve in between the AA and the PAPA that potentially represents kind of like the cost of society, right? People think that they're going to a good restaurant in terms of hygiene quality. Who knows? Maybe you're going to get sick. There's, a food poisoning. All kinds of bad things can happen, and that's kind of the unintended consequence of having this kind of grade pending system in the New York City hygiene inspection regime. Now, how does this fit? I kind of talked about the societal component and all that stuff. How does this fit into an AI talk? Well, our solution was first to uncover this and then to think about, how could you resolve this using kind of the Dominique Ansel story? The fact that people are posting pictures of restaurants and food and talking about their experiences online. And so, this paper is at this stage maybe 2 or 3 years old. And so to me, at least, I wasn't really even aware of large language models and what I guess everyone here would call AI at the time. So this isn't really AI in society. I'd call it ML in society. And we were just using more or less standard machine learning techniques. The innovation is just showing that you can tune them specifically to pick up hygiene related content. And from that, basically form a live real-time or nowcasted score, if you will, of what the hygiene score would be if the restaurant were inspected today, as opposed to 9 months later, or whenever the next inspection would be. So that's basically the quick overview of this paper. I really enjoyed working on this, and I would love to continue working on papers like this, where there's a text mining piece to it, kind of an economic/policy piece to it. And in particular, recently I've been thinking a lot about how to measure things like inflation, because within um, uh, some part of the world, part of society, there's real skepticism around the official numbers for inflation, arguing that maybe they don't take into account things like shrinkflation, which is like when the company, rather than having 300 pieces of toilet paper, maybe they give you 275, but sell it at the same price. The consumer actually has no idea because it looks so similar. So can you detect this using social media? There's also other kind of more policy issues, like when minimum wage changes and so on and so forth. Can you see how people's experiences change, maybe service quality changes and things of that sort? So there are a lot of questions, I guess, that I'd love to explore. And if anyone's interested, shoot me an email or we can have a chat, I guess, afterwards. But in any case, yeah, so that's kind of the text mining side. What I'll get to now is the actual paper for today, which is on trying to measure risk in the banking sector. So let me take a sip of coffee, excuse me. I have a 3-year-old daughter and she did not sleep well last night, so I did not sleep well. So I need that coffee. Okay. I think an even bigger problem than potential foodborne illnesses, right? Which is very unpleasant, but usually doesn't like kill people or anything. I mean, in extreme cases it can, but it's not very common. A much bigger societal problem is that of financial crises. And why is this a problem? Well, if you think back to the last major financial crisis that we had, 2007, 2009, the mortgage-backed securities crisis, it clearly induced a very large societal cost, right? Economic growth was very slow for many years, arguably still is, because we're dealing with the deleveraging of that. Like people are still paying off debts that were incurred as a result of that or the consequences of that in the following years. We had direct bailouts, which are very politically unpopular. You might even say it's connected to the rise of President Trump and then Biden, and like the whole path of the country changed to this financial crisis. If you look at some of the official documentation around it, 8.5 families were actually foreclosed on, lost their homes. Unemployment rate hit almost 10% in October 2009. People's retirement accounts dropped about 55% in value, which if you're getting close to retirement can be very scary, I think, from about a period of 18 months. And then we should never forget, the TARP, the Troubled Assets Relief Program, which spent about $500 billion of taxpayer money simply buying these, worthless assets from banks to stabilize the financial systems. This is what's commonly referred to as bailouts. So this is obviously suboptimal. We don't want financial crises. And well, of course, this was 2007, 2009. You might start thinking with the current climate, economic climate coming out of COVID and so on, is there another financial crisis brewing? All right, and this is actually an active, point of debate in finance. Although I think the consensus view is that actually the banking sector is pretty sound right now, but there is still some debate on it. And here's like a quick overview of why people think there could be something bad happening, potentially like literally right now, and it will blow up in a few weeks or months. So let's say it's 2021. You bought a home, you got a mortgage from a bank, a 30-year mortgage, and the bank gave you an interest rate of about 3%, which actually is quite reasonable because interest rates, like the Fed, the official interest rate that the Fed is trying to manage was near 0%, right? So a bank making a 3% mortgage is great for them because they're able to collect 3% on whatever they lent you, and that is way better than they could get by just parking their money and getting a treasury bill. And just in case the bank, had some financial difficulty and they needed to raise cash really quickly, they could take that mortgage and then like sell it to another financial institution. It would be worth a lot because it's interest rates much higher than the the interest rate that the Fed gives, and people are happy. Now, fast forward to 2024, the current year, of course, interest rates on treasury bills are well over 5%. And that 30-year mortgage that they made in 2021, that bank is still holding that mortgage. They have to hold it for 30 years, right? It's only giving them 3% interest. But now government treasury bonds are worth like way more than that. You can get basically double the interest rate, I think, right now, just getting a risk-free bond. So now the issue is, just in case the bank actually needs to raise cash, what do? They sell their assets like mortgages, right, to somebody else, and that's how they're going to raise cash. Well, who wants to buy a mortgage at 3% if the current interest rate is way above that? Basically, that mortgage is worthless. And so if the bank does need to raise cash, they sell it at a severe discount. And it turns out that, a lot of banks are holding a lot of these mortgages. And when interest rates have gone up so quickly, it leads to a lot of failures. And so last year, almost exactly a year ago, we had 4 bank failures that was due exactly to these issues of rising interest rates. They had things like bonds or mortgages that basically became worthless. They had to raise cash for whatever reason, and they couldn't raise enough cash because those assets had declined so much in value. I guess what I'm saying here is that, if you really want to assess risk for a particular bank or the banking sector, you could like look at their financial disclosures, or ideally you look at their balance sheet, their disclosures as of today. And then you'd say like, well, how many mortgages did they make at what interest rate? And then you could actually calculate out like, oh, what is it worth on the open market? Do they have enough to meet their liabilities and all that stuff? I guess the problem is that filings by banks and by publicly traded companies generally are only made quarterly. And when interest rates are changing, they don't happen on a quarterly basis. They can happen kind of anytime. And you might want to know, like, now also banks are trading assets and changing their balance sheet actively. So you might want to know, like, as of today, what actually is the balance sheet look like for a bank? And if you can figure that out, then you can more properly assess risk and potentially get an early warning indicator that's saying that, hey, there are a bunch of banks, they're approaching a danger zone, if you will. And if you're the Fed or the Treasury Department, you can then do something about it in advance before there is a financial crisis like we saw in 2007, 2009. Maybe I'll pause just for a moment. I don't know if we typically take questions during the talk, but I don't want to lose anyone at this stage. Does this all make sense? Let me know if you have any questions. Feel free to interrupt. Okay, so hopefully that's a setup for this talk. And what we're trying to do is, again, we're trying to like infer the daily balance sheet of a bank, particular asset categories that are of interest from a risk perspective. And where are we? How are we doing that? We're going to actually do some kind of fancy decomposition of stock returns. So from stock returns, rather than wait for the quarterly numbers, we can use the previous quarterly number and figure out, as of today, what is that? What are their cash holdings, for example, and so on and so forth. So what you see here is kind of the headline, I guess, for the paper. There's a bunch of methodology and statistics and stuff and finance, I guess, that I will skirt over later. I guess it's probably not the key thing for this group. But what's the upshot of this paper is that you can actually use this proposed method to do risk monitoring and identify troubled banks well before they potentially fail. And so that's actually what you're seeing here. These are 4 different asset classes: cash, loans, securities, and then repo, which is basically the repo market. How much assets are they lending to other banks or other institutions? And these 4 lines are the banks that actually failed about a year ago. And so, for example, you can see Silvergate Bank failed. The last observation is here. Silicon Valley Bank and so on failed in mid-March. and so on. And I guess what I'm trying to show you is that the gray band, what you're seeing there, is basically the mean. So if you look at the banking sector for a comparable set of banks, that gray is the 99% confidence interval. And these four banks clearly fall outside of those bands, right? So they're doing something weird to be that unusual. And this is like real-time methodology. So in other words, if you see a data point plotted in February, that would be literally the estimate that our model produces as of February. We're not using any forward-looking information or anything like that. So if you're just looking, hey, what banks are falling out of these bands? Is there anything unusual about them? You would actually identify the troubled banks well before they actually failed. And that would obviously be useful for investors and for regulators. It turns out also that without getting into the specifics, because I know not everyone here is, a banking expert or cares so much about this 2023 episode, the graphs that you're looking at are actually pretty interpretable. So for example, you can see this big spike in First Republic Bank. If you were to trace the news back then, there was this big cash infusion. Other banks just simply said, here, just take the cash. We don't want you to fail. So here's $30 billion, right? And so they just put a ton of cash on their balance sheet. People still got nervous and depositors left. So the cash holdings went way down and then they ended up being acquired by JP Morgan later. But anyway, so this is quite interpretable and useful from a monitoring perspective. And in fact, if you were to kind of look at the outliers, if you will, and see what happened to them at different points in time, you can see that for an early warning system, or if you wanted to trade maybe in short banks or whatever you guys want, the public wants to do with the research, that's their business. It does seem to correlate really well with actual outcomes. So, the banks that we identify as being highly unusual actually do seem to be having credit downgrades, potentially actually failing and so on and so forth last year. So yeah, that's the headline. I guess what I'll talk about is how do we actually do that? And, what does the methodology look like? How does it work? So at a high level, let me just check time. Okay, cool. We have about a half hour. So at a high level, what the method does is it takes stock returns and does matrix factorization. So if you guys are familiar with principal component analysis or singular value decomposition, that kind of thing, we're doing something like that. It's a variant, so it's not actually singular value decomposition. It's a form of non-negative matrix factorization, which is just another type of matrix factorization. But I guess a novel thing, and I think something that's really useful to make economists feel comfortable with what we're doing, because it turns out there's this huge divide. Like in order to get the Fed to take you seriously, you have to be able to speak their language, basically, right? So what we do to make people who are in the position of policy feel comfortable with our method is we actually try to motivate the matrix factorization using a stylized model of the bank balance sheet. And so I think this is the first paper I'm aware of that actually kind of ties these two completely separate literatures together, saying that actually you can do a matrix factorization of stock returns, which people have done for a very, very long time, but it very fundamentally relates to stuff on the balance sheet, which obviously relates to all these risks implications and stuff. So one of the latent factors is going to be very interpretable, and it's going to be basically the percentage holdings along different asset classes. So that's exactly what I was kind of plotting here. So the way you'd interpret that is like if you see the cash for First Republic Bank is around 0.3, that literally means 30% of all the assets that First Republic owns, 30% of it is in cash. So that would be the interpretation of that matrix factor. The way we actually do the estimation is with Bayesian methodology. So we do an MCMC estimator. I think from a statistical point of view, it's very standard stuff. But there is a nice thing that I'll get to, which is in matrix factorization and in non-negative matrix factorizations in particular, there's kind of a rotational and scale invariance problem. And through the way we set up the factorization and the estimation technique that we use, we resolve these issues. So it has a kind of a nice technical contribution as well. Okay, so I hesitate to go over too much of the finance stuff. So I guess I'm going to go over it at a very high level, and I'm actually going to skip the notation slide and stuff because I feel like uh, if I present this to a finance department, I would spend all my time here, and then we get bogged down in the details of what the stuff means. But if we're at a high level, we only have an hour. We don't need to worry about, I guess, that level of detail. But if you have questions or something, I'm happy to clarify and go slower or focus in on something. But anyway, so the basic idea to motivate the factorization is to start with a stylized model of the bank balance sheet, and that's what you're seeing on this slide. On the left-hand side, you have N will end up being the number of shares that bank I owns an asset K on day T, right? So the different K assets are exactly what I was showing on that plot, like cash, loans, and so on and so forth. And then T is just daily. And then you have banks are indexed by I. And then YKT would just be the price of that asset. So if you multiply the number of shares times the price, that's the value at that day of the asset holding. So that's a total portfolio of assets. And on the liability side, you have very standard stuff. You have bank equity and then debt that the bank would incur. And then the very basic thing you do in accounting, almost the only thing I know in accounting, is that the asset side has to equal the liability side. So you literally add up each side, put an equal sign between them, and that's always going to be true. This is it's an identity in accounting. Now, what we do is to kind of get from this to our matrix factorization is start looking at first differences. So this is the balance sheet on a particular day, but let's look at the change in the balance sheet between days. So that's what these deltas are supposed to represent. We're just taking first differences and doing some algebra here so that the change in equity is on one side and everything else is on the other side. And again, like without getting too much into the finance, banks don't change their debt levels on a daily basis. That changes at a much slower rate. So the first difference would cancel out. And then again, like I'm actually going to show the proof or explain proposition one too much, but there's an argument to be made that once debt cancels out, you can actually replace N, which is the number of shares, by W, which is that percentage. So now WIKT, right? This is going to be literally, again, the percentage that you own in cash, the percentage you own in bonds, percentage in stocks, and so on and so forth. And that will, of course, add up to 1. So we have our final equation. You can start from the accounting identity, take first differences, some argument to get the W in there instead of the N. And this should start looking like matrix algebra, if you will, if you're coming from that world. But the W looks like this matrix, and the Y is just some vector if you ignore the T index. And indeed, that's exactly what we're trying to do. So on the right-hand side, we don't know the W, we don't know the Y, but we want to infer them. And the epsilon is just error, random error, right? And on the left-hand side, we have the change in equity, which is like the change in stocks, the stock return for that day. So that's going to be, we observe the left-hand side, we want to infer the right-hand side, and the W is really the point of interest from a risk point of view, because if you know the W's, then you can, of course, plot them like I was plotting before. And you can also do things like you see at the bottom here. If you know like the percentage holdings along different asset classes, you can see the Herfindahl index, like how concentrated actually is a bank on a particular asset. Like if they're holding a ton of securities or a ton of loans or something, that's actually an indicator of risk, right? Because if that particular asset class gets hit, then the balance sheet will fall apart for the bank. So that's like diversification risk or undiversification risk. And then you can also look at the similarity between banks, which is kind of the bottom measure. And this is what's a big thing, which is called contagion risk in the finance world, where you have like if one bank fails, another bank fails, and so on and so forth, the cascading effects. Because again, like even we may be really well diversified, but if we hold exactly the same balance sheet, then whenever one bank gets in trouble, that almost implies that everyone else is in trouble too, because they all kind of look the same. So, and there are other risk measures as well you could cook up, but you can see the utility, hopefully, of estimating these. And if you're wondering like what the Ks actually are, what the assets actually are, that's what the table at the top is showing you. So we have cash, securities, repo, loans, and so on and so forth. Okay, now to get this to actually be identifiable, like, let me just go back a little bit. If we observe on the left-hand side stock returns, and we have like n banks, let's say, that would only be for a particular day. You have n observations. On the right-hand side, this is an n by k matrix. So and then you have the vector y, which you don't know. So you have like a lot more parameters on the right-hand side than on the left-hand side. The way we actually get this to be estimable or identifiable is by using a rolling window and having some kind of stationarity assumptions there, which I'll kind of ignore the technical details for now. But you would have this rolling window, and within that rolling window, you can, whoops, see daisies, you can combine your daily stock returns. So now the bold face is supposed to represent a matrix or a vector. So you can see we formed a matrix of stock returns. And then from that, we do our matrix decomposition and we get the W and the D out of it, right? And I guess the kind of one of the key things here is that the W are essentially percentages or probabilities. So as all probabilities are, they have to be between 0 and 1, right? So it's they can't be negative, and there's a sum to 1 constraint on each row. And this ends up being kind of a critical constraint that gives us a lot of interpretability. So I just wanted to emphasize that. The V, on the other hand, can be anything, any real number. So this is what's known in the matrix factorization world as semi-non-negative matrix factorization. So people have been doing this decomposition for years, and in fact have been applying it to stock returns without ever actually making the connection to the balance sheet and that kind of thing. So you can see if you kind of write this in the usual matrix factorization world way with the Frobenius norm, you get what's on the left-hand side. I went through the kind of interpretation of W from a finance point of view or econ point of view. It's the percentage invested in different asset classes. Coming from statistics, this looks familiar to me more along the lines of clustering. And so my very, I guess, weak connection to AI and society, the AI piece for this paper would be, hey, this is unsupervised learning, where by estimating this matrix factorization, really what we're doing is saying, it's not K asset classes, it's K clusters. And we're trying to compute the posterior probability of each bank belonging to a certain cluster. And so that would be that view of the world. And in fact, you can explicitly show that the proposed factorization we're interested in is a variant of k-means clustering. So it's a soft version of k-means clustering. And there's like an extra piece here, which I'll try to get to what that means kind of conceptually. But on the left-hand side here at the very bottom line, I don't know if you can see my cursor, but that is literally the objective for k-means clustering. And then you can see there's something else going on here. So we're just kind of, if you will, generalizing classical algorithm in the machine learning world. Now, just to show you what this means from a statistical point of view, this is the standard k-means stuff. So let's say that this is your data. You have Z1 and Z2 are the X and Y axes. So that's like your X variables or variables you're clustering on. The dots are the different banks. And as you would in k-means, you kind of throw your cluster means randomly at the board, the slide, and you do your kind of variation in your EM algorithm. So first thing we do is we optimize with respect to the W's, which would be like the probability of belonging to one of these clusters, which is just proportional to the distance, right? So we'd say, hey, these are more likely belonging to these 3 clusters because they're closest to the cluster means. Based on this membership, we update the cluster means, which is what W represents. We go back and reassign points and so on and so forth. It just keeps cycling, right? The classical k-means. Now, if you want to know like what the additional piece is, I don't have an animation for it, but essentially it's just relaxing the assumption that everything is a perfect Gaussian distribution. So you can have different orientations. The covariances can be a little bit non-standardized. And so the clusters can be aligned in different ways. And in that sense, it's a little bit more flexible and kind of gives intuition for why the NMF models in general have been very popular in the unsupervised learning world, and very useful for things like image segmentation and so on, because they're not relying on a strict Gaussian, perfectly distributed data. There is a little bit of relaxation there. So that's kind of the statistical view of what we're doing and what the model is. The last thing I'll mention is the kind of applied math interpretation, which is, as I mentioned, the special case of semi-non-negative matrix factorization. And here, I guess I know the audience is very broad, so there are some technical issues with this type of matrix factorization, which is that there are an infinite number of solutions, and the reasons why has to do with rotation and scaling. And the upshot of all this is just that sum to one constraint and the fact that the W's are probabilities. You can prove that basically you don't have an infinite number of solutions. You only have one solution in this case. And so we have actual identifiability in our case, which is why you can use this methodology for something like monitoring, and economists would feel a little bit more comfortable with it because there's actual identifiability here. So it's a kind of an important contribution for a kind of a nice technical thing, but also if you want to convince policymakers to use a machine learning method, you can't have it change depending on the random seed and all that stuff. So here we resolve that issue. In terms of estimation, there are several approaches. If you write, such a model, you could, as I mentioned, just write an optimization problem and then solve that using, gradient descent techniques, have a Lagrangian penalty. If you view it like a statistical problem, there's the EM algorithm that, where the cluster means are V and the cluster memberships or the parameters you're maximizing over and so on. We took a slightly different approach because, again, we're really doing this from a perspective of policy, or I'm doing this from the perspective of policy. So I don't care if the algorithm is slow, and indeed our estimation is extremely slow because Markov chain Monte Carlo estimation is not going to be as fast as projected gradient descent. It's just computationally not comparable. But I think there's a lot of people, again, feel good about the theory around Bayesian estimation and MCMC in particular, in that if you can set it up correctly, there's you should have confidence that you've converged to stationary distribution and your estimates are appropriate, are the right ones. So the way we set this up is, well, you can see here, I guess, the distributions are in some cases made for some computational efficiency reasons, like using the normal distribution in some cases. The main thing is that we're using the Dirichlet distribution for the rows of W. And this is important because that basically encapsulates that W has to be a probability. And so in the other approaches that I mentioned, where you kind of solve it with optimization, oftentimes you kind of treat that constraint as a soft constraint. And by explicitly using the Dirichlet distribution here, we're kind of satisfying the probability constraint exactly. And again, that just helps with identification and estimation quality. So I will skip some of the details again on the actual estimation. From a statistical point of view, it's very standard stuff. We're using Metropolis Hastings and Gibbs sampling and stuff like that. again, if you're interested, happy to chat more afterwards. When it comes to validation in the actual empirical work, so we did all the setup, we have the accounting model, we motivate the factorization, have these different ways of doing the estimation, including the Bayesian way. We had to, or we tried to do a pretty rigorous estimation. So first thing is we have done simulation studies, which due to time constraints, I won't show here, but the upshot there is basically our method is really slow in terms of computing time, but seems to produce very high quality estimates. And then from a more application context point of view, we tried to do the validation using real data on two different settings. So one is like mutual funds, and the other one is FDIC like bank filing. So we can basically, we get the stock returns, let's say for all these mutual funds, we estimate what their holdings are. In fact, here are the different asset classes for the mutual funds data set. So certain stocks hold a lot of common stocks, other ones hold bonds. You can have asset-backed securities, all this kind of stuff. And depending on the mutual fund, right, some of them will hold different types of portfolios. The nice thing about mutual funds is that it's very upfront and easy to get the data on like, what is the mutual fund doing, right? Like, and what should their portfolio look like? And they're very, very transparent. It's easy to get that data. So we also look at, so basically, the setup is we get their stock returns, we do our estimate of W every day, and then we compare the W based on stock returns on the day of the filing of these mutual funds. And then we just see how close are our estimates to the real thing. And without going into the detailed results, we're looking here at those two indexes I mentioned. How concentrated is a mutual fund, in this case, on a particular asset, and how similar across mutual funds is the entire like industry, if you will, the entire sector of large mutual funds. And you can see the blue line with the triangles, excuse me, the blue line with the triangles is what you would get if you look at the official filings and compute it using, the regulatory numbers on the financial disclosures. The red line is what you'd get if you just look at the stock returns and you use our methodology. And okay, they're not exactly the same, but they are pretty close, I think. And from the perspective of monitoring and identifying outliers and this kind of thing, I think this is actually great. I mean, we're clearly capturing the trends, and they're fairly highly correlated. And I think also the discrepancy between the two series, we have some reason for that, which I won't get into. It has to do with some of these asset categories are really close to zero. Like if you're a bond fund, you're not holding any stocks. And the Dirichlet distribution oftentimes will give you a small decimal close to zero, but not exactly equal to zero. And so that's where the difference in the estimate and the true is coming from. Same thing for banks. Here we're using data from the FDIC. We can do a similar kind of validation, and you can see the quarterly numbers here. Again, the estimated is not exact, but it does kind of capture the main trends that you'd want to see. I'm a little bit concerned with the noisiness of the similarity index. Something that is kind of an active working paper, if you will, for me. So I'm trying to think through why is it so noisy and so on. But is our method getting sensible estimates, and can it be used for monitoring and so on? I think that the answer to those questions are yes. And again, going back to the kind of headline plots that I showed earlier, if you plot concentration and similarity, you can see that those 4 banks that failed in the first quarter of last year do stand out on these metrics as highly unusual well before they failed. And if you're, like a amateur investor like myself, or somebody very serious like an economist at the Fed, I think you could look at these plots and say like, oh, that's weird. What's so unusual about them, right? What are they concentrated on? Or why are they so dissimilar to the rest of the market? That's when you can go and look at the actual granular estimates of W, look at each of those columns individually, make plots like this, and now you can tell a full story of like, yeah, it turns out that Silicon Valley Bank is highly concentrated. They seem to be doing something unusual from the rest of the banking sector. How were they unusual? What were they concentrated in? They were holding a lot of what were classified as loans at the time. They were really low on cash holdings. And so when there was a real pressure point and they needed to raise funds, they had to sell all that stuff on the open market. And it was that story I told about interest rates. Basically, they couldn't get enough to be solvent. So that's where the paper stands. I think it's still kind of work in progress. I think the methodology is more or less set, but really I'm trying to work on the empirical side and fleshing out more case studies and trying to show this can be useful in practice. So I guess I'll stop here and just highlight some contributions. On the more method side, I think I didn't really talk about it too much in this version of the slides, but we do show that there is a pretty big difference between the Bayesian approach and the more gradient descent style approaches that are common in the matrix factorization world. And in our case, where stability is really important, I think the Bayesian approach has some advantages. And on the finance side, what we're doing is I think is extremely weird because I'm coming at it from as a really a pure outsider. I'm a statistician by training, but I've also spent a fair amount of time working at the Fed as a visiting scholar. I was an intern there many years back and have been collaborating in the finance space for a while. So I'm trying to bring this outside methodology and kind of really blend it nicely into what they feel comfortable with. And so we get something that's actually useful for regulators and investors and so on. So yeah, that's all I had prepared for today. Thanks for your attention.
If anyone has questions, you can just raise your hand. Dr. Bauer?
Hi, can you hear me okay? Great. So I was just wondering, it seems like a lot of the basis for your work, or the main basis, was assessing stock market, or this stock market situation to make predictions about how a bank was going to do or something like that. But were there other variables that you would consider as possible predictors of where a bank was going in the future? For example, reactions by the Federal Reserve, even statements that various Federal Reserve officials make, which can influence what people then do, or what other factors might you include in trying to make a more accurate prediction?
Yeah, I mean, I think certainly having some covariates like that could clean up the results a little bit further, particularly because we're using stock returns as the basis from which we're inferring all this information. And stock returns, like you say, are actually highly sensitive to things like, the chairman says something about how he's feeling that day, and suddenly the market drops, 10% or something. So so I do think that could help. There's a related project that I just started thinking about with actually the same collaborators, which is now casting stress test results. And I don't know if you're familiar with the stress test, but basically, every year banks have to go through these simulations that show that they're going to remain solvent even if the economy crashes. And in that world, I would love to do the nowcasting with the NLP component, which is we're ingesting all the stuff that the Fed says publicly to somehow characterize the state of the macroeconomy, which can then feed into how you'd nowcast, how banks would perform under different scenarios.
Thanks. That's helpful.
Darby?
Thank you. Sean, one of the things that I found really interesting was when you were saying that, you know, in order to really get this out there and get the right people to pay attention to it, you were putting these things into the format of the bank balance sheet, um, and it just made me think about, and I'm gonna ask this is a very general question, but it made me think about how a lot of times now we're looking more and more at the products of AI and machine learning algorithms being presented in ways that look very familiar to us, that may not look like AI or machine learning. And I'm kind of curious from your perspective in finance, what are the things we should be thinking about when it comes to the way that these results are presented to various publics?
That's a question I've never thought deeply about. So I was a little bit definitely off the cuff. I guess it depends on exactly who the constituency is. Since you asked your question with respect to finance, like I think regulators and like folks at the Fed are certainly a little bit hesitant to use stuff that appears like a black box. And obviously, you know, trustworthy AI systems and interpretable machine learning and all that kind of stuff is huge active areas of research. And I think that stuff has a lot of merit, like to really, for use cases where real money and policy things are being decided, you really can't have unexplainable results or something. Like people need to feel very confident of what they're looking at. Other parts of finance, like more on the trading side, I'm a lot less familiar with what, you know, a hedge fund or a trading desk would do at Goldman Sachs or something. But I'm going to guess that they don't really care as long as it's predictive. Then they can make money off of it because, you know, that's their job. It's just to predict a little bit the future. And so in that world, I guess it wouldn't matter so much. And all the advances that we've seen very recently must be filtering into that world at an extremely fast rate. It's just my quick take on it.
Okay, I think we're almost out of time. Does anyone have any other questions?
Well, some parting words, perhaps. I'm very serious about wanting to meet people on campus and, you know, have more discussions and so on. So if anything was of interest or you think, you know, it's worth chatting, please don't hesitate to reach out and love to grab coffee or something and chat.
Thank you so much for a really interesting presentation.
Yep, thanks everyone.